I hope you get the pun here. Learning Objective 4-2. Understand and explain how consolidation procedures differ when there is a differential. It's not my pun. Let's just look again what we're doing. We're in Chapter 4. So Chapter 2, no differential, wholly owned. That's it. Chapter 3 was partially owned. So there was a non-controlling interest, but no differential. This chapter, we have fully wholly owned again, so no non-controlling interest, but there is a differential. And Chapter 5 is going to put everything together. Partially owned, where there is a non-controlling interest, and there is also differential. So here's a nice little example to show you how everything works together. Assume the book value of subs net assets is 800. The fair market value of the net assets is 1,000. The acquisition price was 1,500. So the acquisition price consists of three parts. Book value of 800, excess value of identifiable assets 200, and goodwill of 500. Using my very elegant method, the cost of acquisition is 1,500. The fair value of the net assets, I like to say fair value because it's not necessarily market value, is $1,000, and the book value is 800. So you have write-ups and write-downs of 200, and you have goodwill of 500. And that's kind of how I like to put it down. But whatever works for you, it's kind of here. And here they're going to talk about we need to keep track of each element of purchase price separately, because we can't just stick assets on the balance sheet. We can't put goodwill on the balance sheet and forget about it. We can't write up or write down our assets and forget about it, because if we write them up, that means let's say it's equipment, they're going to have to hit the income statement somehow. So if it's land, when you sell the land, then the land has been written up and it's going to have a smaller gain, like we saw in the previous example. If it's equipment, it's going to require additional depreciation. If it's goodwill, it needs to be tested for impairment. Equipment and land needs to be tested for impairment also. So we have to keep track of these things, and the weird thing is that the sub may keep them on their books at its original cost. So the only person to keep track of this is going to be the parent, i.e. not person, the parent's accountants. So when you consolidate, there's a number of different things you're going to need to do. One of them is going to need to update the assets and liabilities to market value or fair value, based on fair value on the date of acquisition. You have to record any goodwill or any new assets that were recorded as part of the acquisition. And then also you're going to need to eliminate intercompany items. So these could be things like investment in sub and then the stockholders' equity of the sub. It could be dividends paid from the sub to the parent. It could also be receivables and payables. If you sub has a receivable from the parent and the parent has a payable to the sub, those also need to be eliminated. So now let's go through the really big entry and turn to our spreadsheet. The spreadsheet that we're looking at here is Peerless and Special 1 template. I don't know if you can hear my kids in the back. I've been doing videos for a long time, and there was one particular summer when my daughter was just born, and I was preparing a new online class, and it was total chaos in the house. There's crying and all kinds of crazy things. They're older now, so they don't cry as often, but I hope you could probably hear this is like a home office I have, and it's right next to the kitchen, so it gets a little noisy. Peerless acquired all of Special's common stock for $340. Special's book value is $300. Land is undervalued on Special's balance sheet by $40. So this is a very simple example. When Peerless makes the acquisition, Peerless is going to debit investment in Special Foods, that's the name of the company, for $340. And the credit would be for however Peerless paid. In this case, it's cash of $340. And if we do this chart, we're going to see that the cost is $340. Now, this is for 100% acquisition. The previous problem was only a 40% acquisition. So cost is $340. Special's book value is $300. And we know that there's a land that's undervalued by $40. So that would mean fair value of the net identifiable assets would be $300 plus $40. or 340, and there is 0 goodwill. So this is a nice simple acquisition, and here you can see a spreadsheet to show how you can consolidate these balance sheets on the date of acquisition. I'm going to credit the investment account. Well, let's do it in 2 pieces. In this chapter, we do it in 2 pieces. I'm going to debit common stock and retained earnings of the sub for 200 and 100, and I'm going to credit the investment account for the same amount. And I'll make this some color. There you go, blue. Next, I'm going to record the differential. There's a write-up here of land of 40, so that means I've got to write up my land for 40. So I'm going to debit land, and I'm going to credit the investment account, because right now that $40,000 write-up of land is sitting in the investment account. So therefore, I'm going to credit 40 to the investment account and debit land for 40. Just one little mistake here. This investment account should be 200 plus 100 or 300. So now the investment account has been entirely eliminated, and the land has been written up to its proper value by $40,000. There's one last thing we need to do, what's called the elimination and the depreciation. When we made the acquisition, Special had $300,000 in accumulated depreciation. But now that we're buying Special, it's like a brand new company. So they shouldn't have any accumulated depreciation. So I'm going to debit accumulated depreciation and credit buildings and equipment, because previously this was buildings and equipment that cost $600,000 but had $300,000 in accumulated depreciation on it. Now that we made the acquisition, we're buying the buildings and equipment for what's equal to its book value of $300,000. So therefore, I'm going to debit accumulated depreciation for $300 and credit buildings and equipment for $300. And again, this is that thing. It's, for some reason in this book, it's very often $300,000. There's some homework assignments where it's not. It's interesting. Sometimes they just assume that you should know that it's 300, and I guess that's just built into the book. I think they have spreadsheets to work out all the problems, including the homeworks. The authors probably created spreadsheets, and this was hard-coded as 300,000, and that's what it always is. So again, if you have a positive differential, the fair value could come from goodwill, as I showed you in my little chart. It could come from the fair value exceeds the book value for certain identifiable assets, and those could be tangible assets or intangible assets. It could also be errors, and errors do sometimes happen on the subsidiary's books, and those may need to be corrected on the books of the subsidiary rather than being added in a consolidation. And I've seen it done both ways. Yes, there are errors. Now, if there is goodwill, that would be a situation where the fair value, the acquisition cost exceeds the fair value of the net identifiable assets. And again, it would be whatever that difference is. And in this case, here they show you the journal entry, excess value reclassification entry. This is actually if they were going to have goodwill on this particular one. They're just showing you if it were, then you would be debiting goodwill in this chart. I'm showing it to you here on the PowerPoint slide, but let me show it to you in Excel. Let's say that it had been goodwill instead of land. Then instead of adding $40,000 to land over here, you'd make a separate line for goodwill, and you would make that for goodwill. And we're going to do that in the next example.